A mathematics professor built a $31 billion fortune using a trading skill that 99% of traders had never heard of. I've been using the exact same technique and it's helped me generate $100,000. In this video, I'm going to show you exactly what it is and how it's improved my trading returns. First, let me go over my previous month's returns. This was for the month of April, up top here. This is using a fully automated portfolio, meaning all of the strategies I run here, which is about 10 automated strategies, are running on the futures markets and they're fully automated, meaning entry and exits are just taken without me actually clicking any buttons. It's all done through code. Then this bottom one is actually a crypto inefficiency that I've been exploiting for the past like 7 days or so, and it's made me a decent buffer on my current month, which is May. This is April, just to keep it very clear. So let me give you a bit more background. There was a mathematics professor at MIT who in 1978 started a small investment firm in a strip mall on Long Island. Now, if you don't recognize his face instantly, this is Jim Simons. He's probably one of the most successful quantitative hedge fund managers ever. He went on to be one of the richest men in America with a net worth of $31.4 billion. His fund, Renaissance Technologies, has averaged 66% annual returns before fees over 30 plus years. Now, yes, after fees, it was, I think, about 33%. But do keep in mind, a lot of people invested in his particular fund were actually employees or very close friends and family, because he did cap the size of the fund. It still was a very big fund. I think it was $1 billion fund, but they didn't expand to be as big as like Citadel or Goldman Sachs, etc., or BlackRock, for example. Now, he really revolutionized how institutions looked at the market and showed the power of a quantitative approach. While most of their tactics were hidden from the public and have been kept very secret and quite successfully, one valuable technique reportedly used in Renaissance Technologies, as well as many other quantitative hedge funds, yet is completely unknown to most retail traders, is forecast scaling. Now, this can be coined under a couple of different names. Some obviously can be continuous signals as well, but there are different ways to use it. At least in this particular video, I'm going to be going over forecast scaling, which in case you're already in the space, then you may have already heard of those. Now, let me tell you exactly what it is. So I'm just going to zoom in here real quickly and move my chart. Here we go. So it's something you could actually be using to exponentially improve your returns depending on your particular strategy type and approach. Now I'm going to show you exactly what it is, a few ways I've used it personally, and the effects it can have on returns. I'm also going to go over some cons as well, because nothing in trading is, just 100% upside. There's always cons, there's always an opportunity cost. Now, in simple terms, forecast scaling is the art of adjusting your position size based on the strength of your trading signal. So in theory, the stronger the conviction, the larger your position. Now, if you're a discretionary trader, you've probably already heard of this, and it's a very common saying in the discretionary space where if you're feeling confident or if you have a certain gut instinct about a particular trade, then you're sizing up that particular trade because you think it's going to be a higher percentage that it's going to be a winner or a higher amount that you're going to get returned, so you're putting more size on that particular trade. Now, while you might have already heard of it, most traders are actually using a binary approach. So they're either in a trade or they're not. A really quick example of this is most people are going to be like, if an RSI is above 70, then they're going short, for example. That is a binary trade where they just have one particular criteria parameter value, and then once that is hit, they're going into that particular trade. But this is very rarely the approach of bigger funds, as they can't move in and out of positions as easily. And this is actually one of the big pros of having a smaller account, is that you can trade more illiquid markets and you can be quicker of getting in and out of positions compared to someone that's managing billions, for example. Is also why, on a quick side note, a lot of the automated strategies that I use aren't going to be as scalable to a $1 billion or multi-million dollar portfolio, as currently I'm the low kind of 6 figures portfolio size, which works really great for my current returns, and I get really great percentage returns based on capital. But if I try to scale that even further, they probably wouldn't work as well because they would suffer more slippage, and obviously I'd have commissions, etc., and all that kind of added up. Now, what funds actually do, if I just put the red highlighter, is they scale based on their conviction. So let me show you a real example of this and how I've implemented it as well in my own strategies. In this case, I'm going to go over a mean reversion strategy. So if you've never heard of what a mean reversion strategy is, or you don't know how it's classified, primarily mean reversion is where you have a mean, or often referenced as a fair value price. And then when it's overextended, that could be, a certain percentage away from a moving average, could be from VWAP, could be from whatever. And when it's overextended, you're going short, saying that it's going to revert back to the mean. And wherever it's overextended on the underside, you're saying it's going to go back to the mean, so you're going long so that it hits the fair value again. Now, most traders, at least from who I've talked to, most of them are using moving averages as fair value. So they'll say, hey, the 50 moving average or the 100 moving average, etc. And they will enter when price moves a certain percentage away from that average, expecting a reversion to the mean. It's a very basic yes or no entry decision. Is it extended by X percentage? They could have put 10%, 20%, whatever it is. And if it is, then they're going in and taking a particular position. But there is a very critical flaw in this approach. Mean reversion often isn't binary. It's actually a spectrum. Now, to put it in as a real life example, I'm going to compare it to an on and off switch compared to, I think in the US it's called a dimming switch. Not 100% sure. I know in the UK we kind of call it one of those switches as well. But primarily what I'm trying to say is a normal switch will just have on off. So you're going to have the lights on or the lights off. With a dimming switch where you can kind of rotate it, you can have the lights on with 10% of its power, you can have 100% of its power. You can pick based on how much light you want from that particular bulb or from your overhead lights. Mean reversion is actually quite a lot more similar to this particular switch. To actually draw that out as a particular graph example, it's not a perfect graph example, it's a bit oversimplified, so my apologies if you can kind of see some of the mistakes, but primarily explains a continuous signal here is where you have a graph that's going between 0 and 1 most of the time. Sometimes it's between -1 and 1, but for most of the time it's 0 and 1. Whereas a binary is you're seeing very sharp on and off basically. So it's going either to 1 or it's going to 0. And when that happens, you're having a bi-signal or a cell signal, for example. Whereas continuous is you're kind of scaling that position as it goes up and down. So you're putting on more position as it goes up and you're scaling off position as it goes down, depending on what your signal actually means, like if 1 is bi and 0 is cell, but that's just based on your particular parameter value. Now in mean reversion, the further price moves from its mean, the higher probability it will actually snap back. Think of it like stretching a rubber band. The further you pull it, the stronger the force pulling it back. Ideally, in a mean reversion strategy, you should be adding to your position as its price moves further from the mean and as the expectancy of the reversion becomes higher. And then as price moves closer to the mean, you should be continuously offloading that particular position. Now, when I implemented this with my mean reversion strategy, I started measuring exactly how far price had deviated from its moving average, just as a simple example, not just to determine if I should trade, but how much should I trade of that particular position. Now in futures, this can become a bit more complicated because most of the time you're having to trade fixed contracts, right? You're not doing anything that's fractional like shares or that's as scalable as shares because, for example, a mini contract, one mini contract is still a decent amount of size. So often if you're going to do this approach like I had to, you have to move down to micros if you're trading a smaller account. If you're trading a large account, then you can stick with minis, you can add, as it continually goes up. But most of the time on micros, I was scaling between, 0 and maybe 15, give or take, contracts. And that's kind of how you're able to do that. Now on equities or on crypto, this is a lot easier to do because you don't have that particular issue. Now this approach suits mean reversion strategies basically perfectly. It plays to the particular strategy's natural strengths. And when I'm thinking about strategies, at least when I'm designing them, I want them to be built as best as I can to their characteristics. So like for trend following, you ideally want very small winners. You're going to have a small win rate. Then your other side of trades that are actually going to be winners needs to be incredibly outsized. You need to try and catch that trend for as long as possible and make as much return on those particular winners. Whereas with mean reversion, most of the time you're not making, 1 to 3 R or anything like that. You're probably making 1 to 1, or most of the time you're also making less than 1 because you're going to have such a higher win rate. Now this will allow you to increase exposure when your statistical edge is the strongest and decrease it when your edge diminishes. And this is ideally what you want in trading. And as I was saying, this suits mean reversion strategies a lot better and plays to its natural strengths. Now this isn't just theory or backtesting fantasy. When I implemented this approach with my own mean reversion strategy, my returns for this particular strategy increased by about 20%. Now that's not saying I added 20% net on top of my gains. That's saying of my particular returns, 20% of that I then added on top, which is still very meaningful pretty much for any strategy, at least in my opinion. But I should be transparent about the challenges. Nothing in trading is going to be perfect. If you hear someone say, hey, do this, and it's going to just, only be winning, or you're only going to make more money and never have a particular con to it, then most likely there's something that they're not explaining very well. And for this particular one, transaction costs can become a serious issue. Now, because you're adjusting your position size very frequently, more frequently than if you were with a binary signal, your commission costs will likely eat into your returns further. So this particular change into your strategy needs to account for that and more for you to actually see properly, higher returns because of it. And this is especially true for smaller accounts or if you're getting a very bad commission rate. So you have to be a bit careful with this. There's also the risk of being over-positioned. If you don't set proper boundaries, which can be hard to actually define, without limits on your maximum exposure, you might end up taking far more risk than you would have intended during extreme market conditions. As with all strategies, mean reversion does lose. Sometimes for a very long period of time, price does not revert back to the mean, and you will often take a loss on that. So if you're continuously adding and you never have a stop of some case of exposure, then that can become a very dangerous situation for most actual accounts. Now, in theory, if you had unlimited capital, it wouldn't actually become really dangerous because you could just always continue to add. But in reality, that isn't possible. So you have to take that into account. Also, lastly, let's not forget the complexity. This approach considerably adds more difficulty to automate and execute than a simple binary system. You need robust position sizing formulas and rebalancing logic. What we're really talking about here is a powerful blend of two concepts. You have continuous signals and scaling your position size based on the signal strength. Think of it this way. Instead of just saying this stock is oversold, which is binary, and you're just saying yes or no, your system is now saying this stock is oversold at a level of 8 out of 10, which is more continuous. Now, this can also be done for an ensemble method, but I'll leave that for another video, as this is a bit more complex where you combine multiple indicators to get your signal strength, etc. Now, in fact, I will be adding complete code examples for implementing this with both futures and crypto strategies, and probably equities as well, in a bootcamp that I run just around backtesting. This should be done around the end of the month, so if you're interested, feel free to check out the first link in the description.